Well, hello and welcome to another episode of the Lending Podcast. We are your hosts here in Austin, Texas. I'm John Burnam along with Jeff Jones.
Hello, guys.
And we're thrilled to be with you again today. We've got an interesting topic for you and one that is hot off the press because I actually get this question quite often, but I just had it a couple of days ago.
I'm dying to know the question.
Kind of how we get our podcast episodes.
Yes. So we're out here giving all kinds of amazing information because we are loan specialists. And you've been doing this for 20 more years than I have.
A lot.
And it's a fun journey. You know, we see all kinds. It feels like it's almost like we're working at the White House, but have nothing to do with politics because we see something new every day.
True.
I'm rewatching The West Wing. I love that.
Nice.
My favorite TV show.
Yeah, that's a good show.
Anyway, so we're going to try to tackle a question that has to do with I have no way to prove my job, but I have all these assets.
Right.
So how does this usually come about?
So asset-based lending, right? And of course, we saw a lot of this 20 years ago. These are not high-risk loans right now because most of the lenders that are doing these asset-based loans, you need a lot of equity. So if you already own the property and you're trying to do a refinance, you have to have a lot of equity, like 30 to 40% of equity. And then if you're buying a house, you're putting a big chunk down with these loans. You're putting 30 to 35, maybe 25% down if we're not verifying income. So specifically, the question was this. One of my real estate agent partners called me this week. He said, hey, I've got a client that has several $1 million, in this case, a lot of money in assets, but doesn't have a job, doesn't have a way to verify income, right? Even if he had a job, just didn't want to verify income, this works.
Right.
And so specifically
or retired.
Yeah, or retired. And that's a huge misconception is a lot of our retired clients believe they can't qualify for a mortgage because they don't have income, even though they may have pension, Social Security. They
just don't have the W-2 1099 usuals.
That's right. But they're sitting on a really large asset base in their portfolio. So what we're really gonna target this one for investors. This is more for investment properties than it is owner occupied. There are some owner occupied variations of this, different type of loan, different terms. But let's pretend for a second this is only investors either buying or refinancing or cashing out of an existing property. Now, most of our investor base right now, if you already own real estate, you have interest rates that are lower than the market. So when we see a refinance for an investor, it's usually a cash out refinance. And they're trying to access equity to go do something else, buy another business, buy another property. And there's pros and cons, of course, to every scenario. So we crunch those numbers. But this specific question was, I have a client, he has a couple $1 million, he cannot prove income. Are there programs that would allow him to buy a piece of property? And the answer is absolutely.
Yeah,
absolutely.
And let's talk about this a little bit. There's a misnomer. I really don't like that word.
Misconception?
Misconception's way better. Yeah. Thank you. A misconception that a loan officer only has certain abilities of lending, of like, this is their box of lending and that's all they do. What's interesting is when we talk with other loan officers, some of them might have products we don't do. And we have products they don't do. So some people can do land, we do land. Some people are really good at HELOCs, we refer those out. Some people have what we call non-QM loans, non-qualified mortgage. These aren't abiding by Fannie Mae, Freddie Mac. These are not conventional. This is the bucket that we're talking about today, is there's a lot of lending out there that does not have non-qualified mortgage options, but there's an entire world of them. I think what was the data we saw in January? It was 16% of the loans, the home loans.
Right.
The home loans, not talking commercial or investor.
Was it 1 out of 12, 6%, or 1 out of?
No, it was 16%.
16%
of all home loans were non-qualified mortgages.
Non-qualified mortgages.
Yeah.
Wow. So
that includes DSCRs. That includes all kinds of stuff. So, but that's a pretty big chunk of volume.
It is.
And all I have to say is, when we're talking about these kind of products, not every lender is going to have them, but a lot of lenders do. There's still a good amount that do. Just kind of like reverse mortgages. Not a lot of lenders have them. 96% of lenders don't have a reverse mortgage product. It's a niche, but we have it.
Yeah.
You know.
Yet 34% of the real estate in this country is owned by baby boomers.
Right.
and only 4% of the lenders out there do reverse mortgages, which is a
and they had a bad taste in their mouth for a long time.
Sure.
There was major changes to guidelines in 2015 that really helped make sure they're safer for elderly folks. So it does have its place. It's probably anyway. We won't go there, but it has a value to it.
There could be some cons for sure, as any mortgage does.
So I took us on a really rabbit trail, but my goal was to say that the things we're talking about, there's a lot of lenders that don't know how to do these. So you might hear wrong information out there. We're trying to give you right information. So you don't have a traditional W-2 or 1099, but you want to qualify for a home loan. And this is what we're going through.
Yeah. And there's different levels of approval for these types of loans. So the least amount of documentation that a lender might need, that we would need for one of these loans, is we just need an application with your name, with your birthday, your social, your residence history. We do not need employment. We do not need income. We do not need tax returns. So that's kind of the base.
So no tax returns.
Baseline.
No income docs that are traditional, because we're going to go off of asset statements.
That's right. And then there's even another level of, if we don't use asset statements, if the loan is a cash out mortgage, we can use the cash out from the subject property loan as the reserves. So we don't even need an asset statement in some cases. Now, if it's a purchase, that's different, because we're going to have to verify where the down payment's coming from. So we do need asset statements. And so you kind of have this two buckets of, we have refinances for investors that we're looking at and doing. We have purchases for investors that we're doing. And so on a purchase transaction, yes, we have to verify assets. On a refinance transaction, we may not.
And one way to think about that is the refinance is basically financing its own property. So the property is financing itself.
That's right.
Whereas a purchase, not just the value of the property is being considered, but the value of your portfolio.
You got to show where the assets, you got to show where the money is coming from, down payment. So, one of the most recent ones, and of course this comes back to the question I had about from the real estate agent, do we do asset-based lending? And the answer is yes, and we'll dive into specifics on that in a moment. But the transaction that we're closing next week for one of my past clients, he has a portfolio of investment properties. He owns, I think, 8 total, and they all have a lot of equity. And we're doing a loan right now for him, for one of his properties, to access a pretty good chunk, like 6 figures in cash out from the property. No tax returns. No asset verification, because the cash out from the property is considered his asset reserves. Now, he has excellent credit. These are not low credit score borrowers. This is 700 plus credit. I think 680 maybe the minimum credit score.
There's still a risk assessment.
There's a risk assessment. Yeah, yes. They're looking at the borrower. But if you think about the lender's exposure, right? And lending is all about risk. At least the risk analysis equates to rates, right? So higher risk, higher rate, lower risk, lower rate typically. And so this particular borrower, incredibly high credit scores, right? 740 plus credit scores, never a mortgage late on any of his 8 properties, has really maintained minimal other debt. So you could just look at his portfolio and say he's managed his finances well. And this particular loan program, as a cash out, is not an asset-based loan from his liquid portfolio like brokerage account. It's more of an asset-based loan on the property, right? And so we're capping the loan to value at 65% on this particular cash out. So he's borrowing 65% of the appraisal, no tax returns, no assets that were verified. Not saying he doesn't have those, you just don't have to verify them. And interest rates are very competitive. You can do interest only if you want to minimize the payment, so you get better cash flow. You don't have to. There's pros and cons of that. But that was a very real example. We're closing that one next week for one of my past clients, investment property, cash out. Now, to answer my real estate agent's question, do we do asset-based lending? Yes, and how that works is we do need 2 months of the assets. So let's say the assets are in a brokerage account, right? A big name brokerage account. So we'd get 2 months of assets, or a quarterly statement if it's a quarterly statement account. So we need the most recent 2 months or most recent quarterly. We're going to take the value of that asset. We're going to multiply it in some cases by 70%. So now we have a number that we use. Then we take that and divide it by 60 months. So we can generate an income, just do some very quick math from there. If you have $2 million in investments, times 70% is $1.4 million, and then we divide $1.4 million by 60 months, we have over $20,000 a month of qualifying income on paper. That is enough for most of our clients to be able to qualify.
Yeah, and a lot of that is built out of that ability to repay. In the conventional timeline, we're always looking at like a 3-year minimum. With a 60 months, they're looking at a 5-year minimum. So because it is a different ball of wax, right? So I really like that, these products are even out there. So a lot of people, don't be discouraged if you don't have traditional income. There are a lot of ways to finance a property.
Definitely.
So is there a way to have kind of a combo? It's like, I make income, but it's not a lot. Can I do this and asset assist or asset depletion?
Absolutely.
So you can do it in tandem.
Yes.
So it's like, hey man, I do make money. I do have cash flow, whether that's a small W-2 salary or it's a 1099 that's just, it's on my tax return. I want it to count to offset so I don't have to show as much assets.
Absolutely.
Okay.
Yeah, that's a great question, because going back to the risk analysis, the more documentation that we can show to an underwriter, to a lender, to an underwriter, the less risk that loan presents, right? So we have income, here you go. We have these assets, here you go. If we're doing some of these loans without verifying any of that, then that automatically becomes a higher risk loan.
Right.
Again, you might just not want to divulge all that information, and you might take a slightly higher interest rate, and that's just a choice, But for us as advisors, we're going to lay out those options and say, well, let's see those bank statements. Do we have bank statement income? Because maybe there's consulting income or a side hustle, and it could be even inconsistent income. But we know we have 12 months of bank statements. I do make money, or I have tax returns, or I've got this pension, but it's not huge. But then I also have this retirement account that's got a nest egg in there, and we're using all of those components together to generate a paper income, because that's ultimately what we're doing, right? Is we're trying to determine a debt to income ratio on paper that reduces risk, that gets you the best terms.
Yeah, those bank statements are sweet. I'm just gonna say it because it's cash flow, right? So it's a cash flow income calculation. So we take 12 months. And we could do 24 months if that even sweetens your income. So usually it's like a 12-month look back, and it calculates your cash flow every month.
Yep.
So it's ins, and it's really good. So we're not even looking at a tax return to see what your net revenue is on your tax return at all. We don't even ask for a tax return.
Right.
We're looking at cash flow.
Right. And then there's additional layers on top of that. The tax returns are really great, and we want to use the tax returns. Sure. But perhaps the property is unique where it doesn't fit into a traditional loan guideline. So we could still want to use one of these programs because of the property type, not necessarily because the income's not there or low. Yeah. So there's really it's just a giant puzzle, of course, like we always talk about. And that's where we get energized and excited to solve that client's issues.
So you might run into this. I get run into this a lot. I'll talk to a realtor about a client they have, and they're like, what do you recommend their product would be, and what would their rate be? I get asked that a lot.
Yeah.
And it's interesting because I try to give an analogy, because even as we're talking, that analogy of okay, this is how I feel, write me a prescription, doctor.
Yeah.
This is what's going on. Can you write me a prescription? And that's really what they're asking, is what's the prescription for this situation? Yeah. And the challenge is we need to see the patient.
That's right.
We need to dive into their story, what they have, what the best program is going to be. And that usually takes anywhere from 20 to 45 minutes with a client.
Yes.
And we can figure those things out. It's not going to be a quick answer for a lot of these scenarios. So because we don't want to do them a disservice, that can cost them tens of thousands of dollars.
That's right.
Because when you start moving from one program to the next, the cost of those programs change drastically, depending on that scenario.
I think we have, as a society, we've gotten used to shortcuts. We've gotten used to being in a hurry. We've gotten used to fast food, if you will, in every aspect of our life. Let's just ask AI
to figure it out for us right away.
Well, and I learned this a long time from one of my mentors, and I love this quote. I might have said it before, but the longest distance between 2 points is a shortcut. And just let that sink in. If you're listening to this or watching this, and you've taken a shortcut before in life that's cost you time, cost you money, just think about that. I cut this corner I thought I was doing something quicker and it cost me time. And something as simple as you're in a hurry to get the milk out of the fridge, and so you're shortcutting it by holding the door open with your leg and grabbing the cup here and grabbing the milk, and then you spill the milk because you're in a hurry trying to take a shortcut, and that didn't cost you time because now you're cleaning up the milk. Right. And we get upset with ourselves because we just cost ourselves time. It's not that we're mad at the milk carton, we're mad at ourselves because we didn't take the time to just the extra 5 seconds, 10 seconds. And I do this all the time. I'm not I'm preaching to myself, but we talked about this, we have to slow down to speed up. We have to take our time sometimes to speed up. And this comes back to making sure that conversation, that really good conversation is had, that discovery call. If you're going to borrow $300,000, $400,000, $500,000 and you don't have 30 minutes for a phone call, I would challenge that. I think it's really important. Like, that first call is so critical, and we find out. Right. So we find out all the symptoms so that we can prescribe the right medicine. Right. Versus hey, just take 2 Tylenol and call me tomorrow, and it's like that doesn't fix everything. Right.
Yeah. So if you are out there and you know your situation is unique, spend the time to talk to a lending specialist that has a lot of options for you. If you're a realtor and you're helping your clients and you're thinking you need to figure it out for them, please don't. Please point them in the way of a loan specialist that'll figure it out for them. And, I really want people out there to have hope that it is possible to buy and get that dream home you want, or it is hopeful for you to purchase even if other people have told you no. So we want the full power of our information out there to help people get these properties they want.
That's right. Yeah, I've had some really good conversations lately, and they're all over the board. The should I wait? And yesterday I had a conversation with the client. His lease is up in 8 months. That is the perfect time to start the conversation. It's like, you're not too early. Right. My lease is up in January. It's May. Let's have a conversation now. Well, I want to wait because I want to do ... I want to get my situation in a little better. I can 100% respect that, because you think to yourself, I'll wait to get started because I'm not ready yet. Yeah. And the truth of the matter is, if you have a professional that will help you get ready and lay out the right roadmap, that's kind of the long route, which could really save you time, versus the shortcut is, I'm going to do what I can now. I'm going to wait to get started later. Then you have a condensed amount of time to make changes and course corrections if you need it. And it may set you back. So,
correct. No, that's good. I like that a lot.
Yeah, you bet. Well, this is great. Thanks for tuning in today. We're excited to continue to bring this content. Gosh, we're going on 1.5 years. It's been a lot of fun. We're really enjoying it. We're hoping that you're getting something out of it, and you can share this and subscribe and download whatever else you do. Share it.
Yeah. Be a part of the Lending Podcast Network. We appreciate anybody out there that's listening, and we're here for you. Give us comments of what you'd like to hear.
That's right. Take care. We'll see you soon.
All right, bye.